You couldn't give Intel away at $19. Now everyone wants it at $39. And I think it's going to make the taxpayer a tremendous amount of money over the next 5 years. While everyone looks at Tesla trading at 13 times revenues and 200 times earnings, the only way you don't make money is if you buy low quality stuff that has balance sheet risk. If you buy the high quality stuff when the weighting is this low in the index, you tend to make enormous amounts of money. You can still get.
I'm pleased to welcome back Thomas Hayes. He's the managing member of Great Hill Capital and also the author of Hedge Fund Tips. Check it out. Very good resource online for all investors. We'll be talking about the Fed. What are they going to do this week? We'll do a preview. We'll talk about a potential China deal. Stocks are up today on Monday on a potential. And of course, earnings season is upon us. Welcome back to the show, Thomas. Good to see you.
Thanks for having me, David.
I want to start with this potential China deal. Actually, it's driving markets higher. Gold is down 3% on the day. Stocks are up, and Bitcoin is up today. So risk on day. New records on stocks on Monday after China and the U.S. officials cool tensions over the weekend, according to reports. Now, no official deal has been ironed out as far as I'm reading. But I think there's a framework that's being discussed. I think we have a very successful framework for the leaders to discuss on Thursday, said Treasury Secretary Scott Bessent. This is days away from November 1st, which is the day that Trump initially said would be the start date for new 100% tariffs on China. So I guess we're not seeing that anymore, Thomas?
Yeah, look, you have, as you said, Bessent said, we have a successful framework. The Chinese counterpart said we have a preliminary consensus. We saw some of our Chinese holdings were up huge overnight. Babo's up 3% and change. The Baidu's of the world were up 5%. So the market is saying this looks money good. We will find out for sure on Thursday. You never know. With President Trump's negotiations, sometimes at the last minute, he'll throw a curveball to get a little bit more for the American people. But on balance, that looks very good. That's constructive. That's why you see tech up big today. But I think we got a lot more to focus on earnings this week. That's going to be the real tell.
Yeah, we'll get to earnings and discuss that in just a bit. But this confirms, I guess, partly confirms the theory that every time a new tariff is announced, that's just a buying opportunity. Do you buy that?
Until it's not. But yeah, I mean, look, as you know, we've been excessively bullish when other people were bearish. And that's now going back, multiple years to the fall of 2022. We did get a little cautious this month. We built up a little bit of cash. We have no margin. And we'll see if that proves to be correct. And if we get a buying opportunity before the final year-end rally, or if this just keeps pushing higher. But a lot of this has been retail driven. You're seeing it in option flow. You're seeing it in triple and 5x leveraged ETFs and all the craziness that's coming with that. But I think when all is said and done, David, price is what you pay, value is what you get. And I think this is the moment of truth this week. And we're going to dissect some of that in the imminent earnings in coming days.
So what are the key drivers of multiples expansion now going into 2026 now?
Well, usually you get multiple expansion when you get growth expansion. And this time is different, so to speak, so far. What we're going to see, as we saw with Netflix and Tesla, the first two kind of Mag 7 Plus that reported, was some concerns about margin compression. And you saw Netflix down pretty big off of that. Tesla was a little bit uncertain off of that. And if we look year on year, David, Mag 7 earnings growth is decelerating from 32% in Q3 of 2024 to what's expected to be 14% in Q3 of 2025. So a halving of earnings growth, and yet the multiple for the Mag 7 basket has stayed well above 30 times. It's usually the opposite. When you see earnings growth decelerate, you see multiple compression, not multiple maintenance or multiple expansion. So, Mag 7, $400 billion of committed capex this year, which is a 67% increase from last year. And so far, very little evidence of return on invested capital, which is why you're seeing earnings growth contract. That's going to impact margins. That, as you saw with Tesla and Netflix, that's going to impact buyback ability, which impacts EPS. So will the market continue to assign a very high growth multiple to a group that is decelerating in earnings growth at present? And the answer is we're going to find out on Wednesday and Thursday.
Right now, there seems to be a trend that the tech companies are spending a lot on capex. In fact, it's considerably higher margin on capex than the other S&P 500s companies. And so, Thomas, the question is whether or not this trend has actually been pushing up the entire stock market. And as soon as maybe they stop spending money for whatever reason, that's when we get a slowdown.
Well, there is something to be said for that. It's interesting. The stock S&P is up around 41% off the April 7th trough. 27% of the Russell 3000 is only up 10% or less since the April 7th trough, which tells you we've basically been in the camp that maybe the Mag 7 needs to stall for a bit on the basis of earnings growth deceleration and high multiples. However, it doesn't mean everything has to do poorly. Maybe the answer is an abrupt shift into those stocks that have been left for dead, that are not the AI cost centers like the Mag 7, but the AI beneficiaries that benefit from the technology and have margin expansion without massive amounts of investment like you're seeing across the Mag 7. So we could see that type of shift. And then you look, we're in the final week of October, David. This is the end of tax loss selling for mutual funds. And oftentimes the stocks that have done worst year to date going into the end of October tend to do extremely well in November, once that tax loss selling pressure is in the rear view mirror.
And so now with AI in full swing on everyone's radars, what are some sectors or plays that investors can take? Are we looking at hyperscalers, construction companies around that are involved with data centers? Are we looking at the big Mag 7 companies themselves, or anything on the periphery? How are you doing this?
We've always looked to find the derivative plays. So one of the holdings that we've had that has been tremendously unpopular was Alibaba. You couldn't give it away 2 years ago. It just kind of was left for dead. China was uninvestable. It turned out it was the cheapest AI play in the world. When everyone was saying it was uninvestable at $60 a share, now people are getting interested at $175 a share. They had $80 billion of cash on the balance sheet at that point. They were generating $25 billion of free cash flow. You couldn't give it away. So that was an easy one. That's just getting started. Alibaba is going to continue to press higher. So while everyone looks at Tesla trading at 13 times revenues and 200 times earnings, you can still get Alibaba at a low double-digit multiple with a huge blue skies ahead. The second way we played that was Intel. No, you couldn't give Intel away at $19. Now everyone wants it at $39. Intel was easy peasy. When the government stepped in to backstop that, the game became, the US government decided, we are not going to depend on Taiwan Semiconductor for all the semiconductors in the world. We are going to stand up Intel. And they're the only game in town in the US that was at the 10-yard line. Gelsinger had actually put everything in place. It's just the board got antsy, even though they authorized him to do everything, because the stock price was down. So they got rid of Gelsinger. They brought in someone that even better, Lip Bhutan from Cadence Systems. He had a 68 plus bagger there. He did a huge turnaround at Cadence Design Systems, and he's going to do the exact same thing in Intel. So they got two tailwinds. One is advanced chip development at their fabs, GPUs, and their legacy CPU business has started to recover aggressively. So that's already up double plus from the lows, and I think it could double again over the next few years as the advanced chip demand becomes basically unlimited. And Taiwan Semiconductor, NVIDIA's biggest problem in terms of growth rate has not been for lack of demand. It's been for lack of supply, because Taiwan Semiconductors capped them at $4 billion of revenue growth per quarter. With Intel getting into the advanced chip game, that was a huge, easy way to play that AI play. And then finally was Comstock Resources, which is a natural gas play. If you consider the data center demand for the next handful of years going into 2020, 2030, you look at some of the Goldman Sachs numbers, triple digit increase, 60% of that is going to be powered by natural gas. And sometime back, you couldn't give these stocks away. Comstock Resources is 75% owned by Jerry Jones. We built up a position, $8, $9, $10. That's just getting started. It's one of the lowest cost producers of natural gas, and that's going to be an AI beneficiary as well. So we're looking for the non-obvious ways, the ones that most of the juice has not been squeezed out of the lemon, where there's a lot of runway ahead. And I don't see it as aggressively in the Mag 7. When you think about some of the names that I've mentioned, with Baba almost tripling off the lows, we think that can double again. Intel doubling off the lows, we think that could double or triple from here. Comstock Resources double off the lows, we think that can double again. I don't think you can say that about too many of the Mag 7 stocks that you expect them to double over the next few years, or could double or triple. I think that would be pretty aggressive relative to a decelerating growth rate and a monstrous amount of capex required, and a big prayer session that they're actually going to get a sufficient return on invested capital prospectively.
And are you banking on energy companies being acquired by the tech companies? Microsoft, for example, is restarting a nuclear facility. Potentially, they could go further into the vertical integration. What do you think?
It's not out of the question. I don't think that's their highest and best use of the capital, but I wouldn't rule it out. That's not in our thesis. The name of the game is the demand is going to be there. And I think these energy companies know that. So why would they want to sell out at historic low multiples? Speaking of energy, by the way, in that basket of 27% of the Russell, that's only rebounded 10% off the April 7th lows, while the market's up 41%. You got energy, you have real estate, and you have consumer staples, the ones that have been left for dead, that I think you're going to see a bid. So as it relates to energy, the sector as a whole is at its lowest weighting in the S&P 500 since when? Since COVID 2020 lows. We made an absolute fortune buying Exxon at $33 and change when oil was trading negative. We are in a position right now with and I'm less sanguine, believe it or not, on the E&P oil companies than I am on some of the servicers, but we're in a position with the weighting so low. If you buy energy when they're this far out of favor, it's really, really hard not to make money. The only way you don't make money is if you buy low quality stuff that has balance sheet risk. If you buy the high quality stuff, when the weighting is this low in the index, you tend to make enormous amounts of money. The last time prior to COVID that the weighting got in similar low single digits was 2001, which was the last tech mania where you couldn't give away an energy stock. And then the next 5 to 7 years, what outperformed? Energy did, value did, international did, small caps did. And I think we could see a similar situation, not that tech has to crash, but in terms of relative performance, where's your opportunity? And you just chase the things that are already up a lot, or do you look for things that can double and triple over 3, 4, 5 years?
Going back to Intel and tech stocks overall, how do you feel about the government making equity stakes or making investments into companies themselves? Earlier in the summer, Intel announced that the Trump administration is placing an $8.9 billion investment into the company to make an agreement, and they'll help expand the company. How do you feel as an investor with the companies getting involved with the government?
Well, I think people complicate the Intel deal. The problem with the Intel deal was the previous administration said, we're going to give you $9 billion because you're pathetic and we think we need you at some point. Trump comes in, he goes, wait, we're giving them $8 billion for what? For failing? No. We're giving you $8 billion. We want something in return. This is not your money, Intel. This is the taxpayers' money. Like, they work, 4 or 5 months of the year to pay the US government taxes. They're going to get something in return. So not only are we going to stand you up, but we're going to give them equity. And then, just like President Trump, commander in chief, goes out and sells planes for Boeing, even though we have no equity stake in Boeing, he's going to go out. If you think he can sell planes for Boeing, wait till you see how many chips he sells for Intel. And you saw it. The next week, NVIDIA was asking Trump for favors to be able to sell some of their chips in China. Guess what? They miraculously put a $5 billion investment in Intel. And then SoftBank, Masayoshi-san, put in a $2 billion investment in Intel. So this is, in terms of Trump demanding that U.S. taxpayers get paid for capital that was already committed, he is being a responsible steward of our tax dollars. As it relates to these mineral right deals, I'm less sanguine on that in terms of I don't want to see unlimited government interference, because there was some rumors earlier like, oh, look how many contracts we're giving to these defense companies like Lockheed. We should have equity in Lockheed. I think that becomes a slippery slope, and that's problematic. I think Intel was different. He walked into capital that had already been committed with no strings attached, and he said, no. If you want the taxpayers' money, the taxpayer's going to get something for it. And as it relates to the rest of them, the mineral rights, I think that's to be determined. We certainly need these specialized resources, and to the extent that the private market can't sort it on its own, could there be different deals done where the public sector comes to bear for national security reasons? Yes, hopefully we can avoid those at all costs. But if absolutely necessary, I think it is something that needs to be done for national security.
The stock's up roughly 60% since the deal was announced late August. I think as an investor, you're looking at this trend and saying to yourself, well, one or two things could happen. Either the government continues this trend. There were rumors that Trump wanted to make investments into some quantum computing companies. That has been refuted by the Department of Commerce. But anyway, if they do continue this trend, we could continue to see stocks being pumped up, but potentially the government may misallocate company resources into things that some investors in those companies may not deem productive. So it's a double-edged sword. What's the future here? What do you think?
I think that the company's board of directors in each respective deal has the opportunity to say no. And what that simply means is, we don't want your money and we don't want your strings. But if they say we want your money, they should expect to have the strings attached to it. And that's, there is some free market element. It's no different than any other outside investor that says, we're going to give you money for equity or for debt. We want this voting right, or we have this say, or we want these terms, or we're not going to give you the money. And now the company can say, keep your money. We'll get it elsewhere with the terms that we want. Or they'll say, we can't get it elsewhere. Therefore, we will submit to whatever terms you deem appropriate. And I think it's no different with the rare earths. I think it's no different. I mean, as far as the quantum computing stocks, that seemed like a little bit of silly season and a little bit worrisome. Fortunately, that's not showing that there's going to be any follow through on that. But to the extent that it becomes a national security. Look, you've got DARPA working on similar things, so maybe there'll be more and more public-private partnerships in the name of national security. But when it comes to investing money in a company and or taking equity or debt, the companies will have the right to say no or demand different terms, and I think that's just the case. Now, if the administration starts co-opting companies, we haven't seen any evidence of that. That would be a different situation, and I think there would be a huge uprising against that type of behavior. We haven't seen it to date. And in terms of Intel, it's proven to be a success. And I think it's going to make the taxpayer a tremendous amount of money over the next 5 years. It's going to be one of the best investments taxpayer money has ever been involved in.
And if restrictions are placed on tech companies for exporting to China, for example, NVIDIA, those restrictions were in place by Trump. But anyway, if they double down, the current administration doubles down, is that a sell-off kind of impetus for you?
Look, I think I was against the restrictions that came to bear by the previous administration. I mean, the previous administration's stance was China bad in every way, under every circumstance. Let's not talk. Trump is China's fine as long as they give us what we want. And if we can come to a deal where we make more money than we lose, then we love China. And if we can't, we'll isolate them and go back to the China bad for every possible reason under the sun, like the previous administration. Trump is willing to talk. Trump is willing to do a deal as long as Trump, aka America, gets paid and benefits from it. As far as refusing to export chips to China in the name of national security, I think it was the worst national security mistake we've seen in many, many years. And the reason is because China used to be dependent on us, and they used to take what we would give them and they would take it with open arms, and they would just funnel money into our coffers and create massive earnings power for the US companies. Now we've said, we're not going to allow you to give us unlimited amounts of money because we're not going to give you our chips in the name of national security. And what China has done is they have gone on to make incredible chips on their own. And on that basis, they've gone from being dependent to now being independent to now being in some areas superior. If you look at some of the large language models like Qwen with Alibaba, like some of the chips that they're developing internally, we kind of let the genie out of the bottle. They would have not been that far ahead on innovation had we continued to supply them and continued to keep them dependent on our technology. Now they're becoming independent and in some areas excelling beyond us.
Okay, let's move on to the Fed. It's Fed week this week. Importantly, Besant has named top picks to replace Jerome Powell. Fed chair finalists are Christopher Waller, Kevin Warsh, Kevin Hassett, Michelle Baumann, Rick Rieder. We have a short list now, and no one's been confirmed yet, but it looks like everyone is, correct me if I'm wrong, but it seems like everybody is supportive of much lower rates. Is that correct?
I think everyone except for one is supportive of lower rates. I think Warsh has a history of being hawkish, and he's playing the game that he's going to be cooperative in order to be given a serious consideration. I think it's not dissimilar to what we saw from Powell before he was confirmed, that he seemed flexible. And then the moment he came in, if you remember the autopilot comment in December of 2018, where he basically crashed the market before Christmas, and Mnuchin had to come in and convene a meeting of all the banks 3 days before Christmas on a Sunday to create liquidity and pump the market back up. I think that Waller for sure, Bowman, all of these are good. Warsh, Rieder, they're all fantastic picks. I think Warsh, you really run the risk of once he's in doing whatever the hell he wants. And I'm not saying he's not competent. He's very skilled. He would be the wild card that I would be very concerned about in terms of maybe keeping things too restrictive too long, thinking he knows better, and maybe putting governors on the economy that don't necessarily need to be there in the short term. So I think 4 out of 5 are phenomenal. Everyone I talk to loves Warsh, so maybe I'm missing something. But if you go back to his stances over decade plus, he's often been very, very hawkish, and now he's kind of changed stripes in order to be in the mix. I love looking at betting markets on issues. Who will Trump announce as Fed chair in 2025? No announcement by December is the majority of votes. And if you actually look at who people are voting or betting on, rather,
Hassett is slightly leading Christopher Waller. I mean, it's pretty close when it comes to these. The first two, rather, are pretty close. Yeah. So anyway, if you had to put your money on it and bet, nobody knows, but who would you bet on?
I think any of those would be great. I think Hassett or Warsh, maybe Bowman. President Trump does like to appoint women to positions. He's been one of the most pro-women, pro-diversity kind of administrations historically. Never gets any credit for that. It wouldn't shock me if he put in Bowman, but I certainly think Waller, Warsh, all of those would be good choices. As far as whether he makes the announcements before December, that's going to be dependent on what Powell does. If Powell cuts this week and he cuts in December, Trump is going to let him ride out like Seinfeld on top and let him have a kind of victory lap and let him go out with style. If he tries to choke things up by either not moving this week, which I think is unlikely, or not moving in December, I think at that point Trump will announce his, top one or top two picks and make it clear to the market that that Powell's a lame duck until he vacates his seat in 2026. But hopefully it'll be a cooperative policy, a pro-growth policy from the Fed, and Powell can go out and have a favorable legacy.
So we're looking at least a 25 basis point cut this week, Thomas. So last time you were on the show, you mentioned to me that once unemployment ticks up, it's a very hard genie to put back in the bottle, I believe, were your words. And now we have 4.3%. Let me just double check. Yeah, 4.3% as of...
Well, we have no idea. We have no data. So.
That's right. That's
and by
2
the
months
way,
ago.
There is that thing called we've got 27 days into a shutdown. Economists estimate 10 to 25 basis points a week for every week of the shutdown. Yes, it's earned back once it reopens, but no one's paying attention to it. I think the longer this thing drags on, if you get that coupled with mixed guidance with the Mag 7, I think you could find ourselves maybe with a little bit of pullback. Ordinarily, when you have these 15% plus mid-year corrections like we had in April, and then you hit all-time highs, there's a secondary correction in that year that averages 6.4%. We haven't seen it yet. Is it coming as a result of maybe some surprises this week? I don't know. But any of those dips, if they did materialize, are to be bought, because year to date, we've got 312 going on 313 central bank cuts this year globally around the world, which is the highest since the post-Great Financial Crisis in 2009. So there's a lot of liquidity sloshing around in the system, even if we get some short-term shocks, whether it's from the shutdown, whether it's from Mag 7 earnings, or something else geopolitical or otherwise. As I said, we've been, accused of being a perma bull, and that's been right. We raised some cash this month. We're, have zero margin effectively. And we've been waiting for a pullback that may never come, which is fine. There's also something to be said for locking in a huge year, but we'd love to see some type of volatility that we could benefit from, and then play into the year-end rally. So we'll see how that materializes.
Well, how significant is the government shutdown on Fed policy decision making? Because on the one hand, like you said, we don't have official unemployment data from the BLS, but we have other private data that's tracking payrolls. But on the other hand, we did get CPI released last week, and so could the Fed just ignore unemployment for now and look at a higher CPI print and maybe slow down their dovishness? Is that possible?
I think it's a low probability that they don't move this week, but as is the case with the Mag 7, the key is going to be the forward guidance. So yes. I think if they're not going to be immensely penalized for more hawkish than normal guidance if they cut. And so what's the downside for them doing it? And I don't know that the market expects them to do it. So on that basis, I would say maybe that there's a surprise in that. they cut 25 basis points, and then they come out hawkish at the 2:30 meeting saying, we don't have data, inflation came in better than expected, but it's still more elevated than we would like to see, or above target, or some type of language like that the market maybe interprets as December off the table for the next few days, and until they start to get employment numbers and realize, no, December's well on the table. The labor market's a little bit weaker. I think the sooner we get that employment data, the clearer we're going to know the trajectory moving forward. But the trajectory moving forward is lower rates, whether there's a pit stop in December or not. Trump has made it abundantly clear that the next Fed chair will be dovish, and so if we pause for a couple of months until Powell vacates, then so be it. But I think everything is pointing toward lower and lower rates for the foreseeable future.
I want to close off, Thomas, on alternative assets. You and I haven't spoken much about the precious metals, but it's become more of a mainstream topic in the last couple weeks to months. Major banks, JP Morgan and Goldman Sachs, are upping their gold forecast by the end of 2026. I believe Goldman has a $4,900 outlook by the end of 2026. This is the price so far. The gold price has pulled back from its highs. This is kind of mirroring what happened in 2011. Anyway, do you have a view on this asset? Do you have an allocation to it? Have you allocated more on this really historical rally? It's up more than, let me just get the exact number here. To the peak, it's up more than 60% year to date.
Okay. So, what's interesting about gold is that it's a non-productive asset. So when people say, oh my gosh, gold is the greatest thing that's ever, look, it's up 61%. Do you know how many stocks are up, over 60% this year? Like, while everyone was focused on gold, the amount of stocks that you could have bought in the April trough that are up double and triple already is unlimited relative to gold. So spending your time on an asset that you're buying in hopes that people will come behind you and push it higher based on demand for fear or geopolitical or debasement trade. Look, if you get debasement, it's like Warren Buffett said, whether we get paid in dollars or seashells or shekels or whatever, if you're buying a business that provides value to the marketplace, you're going to command the most of those seashells, shekels, gold coins. It's really immaterial. The key is buy a productive asset, and if there's a debasement trade, you'll just get more shekels per value provided, and find great companies when they're temporarily impaired. And doubles and triples over a 3 to 5 year period are relatively easy to find if you have a solid framework. As far as gold, you're effectively guessing. I think the theme is correct that the dollar is going to trend weaker over time, in which case gold in theory should remain elevated. But why play that game when there's so many other opportunities where you actually have some level of control over analyzing the forward cash flows and what you'd be willing to pay for those forward cash flows versus just hoping there are other buyers coming in behind you. So to those who have allocation, have been gold bugs for the last 20 years and now have their day in the sun, congratulations. This is the day you've been waiting for. Like they say, the most expensive drink in the casino is the free drink because it means you're still at the table. So take a few chips off the table, take your free drink, maybe let a few chips ride if that's your game. But beware, because the clock strikes 12 and we'll see if Cinderella does okay.
A couple of years ago, Berkshire Hathaway did own Barrick Gold for a few months, I believe, until they sold it off. And the play there, and Warren Buffett has never liked gold as a bullion, mainly for the reasons that you've talked about. But he did buy a miner. Would you consider a miner if the free cash flow is extraordinarily strong at current gold prices? I'm not saying they will be, but
Yeah, no, I found that the miners, no matter how high the price of the underlying asset goes, they somehow figure out a way to lose money. Like invariably, maybe they get a quarter or two where they generate free cash and everyone says, oh, this time is different. But somehow that mining business is a really difficult business. I don't think that was Warren himself. I think that was his Todd or Ted. And you see these tiny little positions come and go, kind of trading. There's never been a Warren Buffett. There never will. We're seeing that. And I could almost guarantee that wasn't Warren's decision.
Okay, fair enough. Thank you very much, Thomas.
Thank you.
We'll end it here. And please do follow Hedge Fund Tips. Very good resource, good summary of the news, as well as other information and analysis and charts. Thomas, where else can we follow you?
Yeah, hedgefundtips.com is the best place. Then you can subscribe to our weekly podcast. There, it's stock market focused, individual companies, ask me anything, questions from the audience. That's probably the number one way. And it's also anywhere you get your podcast, Hedge Fund Tips with Tom Hayes, and the YouTube channel. If you go to YouTube, just type in Hedge Fund Tips and all of our stuff is there.
Okay, excellent. Thank you very much, Thomas.
Thank you.
We'll see you again next time.
Appreciate it, David.
Great. Thank you for watching. Don't forget to like, subscribe, follow Thomas, and follow this channel.